Hey guys, welcome to the channel. Today we're going to talk about very exciting, one of the most boring topics in mortgages. Until you understand it, then it's not so boring. We're going to talk today about loan level pricing adjustments. Before we dive in, of course, I have to introduce myself. My name is Charlie Shammy. I'm the CEO of a multi-state mortgage company headquartered in Michigan called Sonic Loans. And throughout my career, I've had the opportunity to help or oversee over 14,000 applications. What I've learned over the years is one of the biggest responsibilities for a loan officer is to structure the loan correctly. The most common mistake I see loan officers do is incorrectly structure the loan. And you can see by looking at knowing and understanding your loan level pricing adjustments to make sure you're structuring it in a way that's one, very advantageous for the borrower, and two, what the investor wants. They're giving you the answer. They're telling you this is what we want based on the loan level pricing adjustments. So you adjust the loan correctly, it makes everything so much easier and better. So let's dive in and get a really good understanding of what LLPAs are. LLPA stands for loan level pricing adjustments, and it's important to know that when you're buying a house, unless you're paying cash, you're likely going to get a mortgage. I think we're past that since you're watching this video. That mortgage is coming from investors. Investors it's not stocks, but it's very similar to stocks. They're investing in something called mortgage-backed securities. And the reason I tell you that is to tell you this. If you have investors on the other end, those investors are looking at risk. And the higher the risk, the higher the reward they want. So they'll assess a file based on credit score, based on down payment, based on all different factors, the property type, if the borrower is going to live in the house or not, and they'll make an assessment based on that risk of how much they would like to charge for that loan. The riskier the loan, the higher the pricing. The less the risk, the less the pricing. Every product, if you're on conventional or FHA or USDA or VA, has their own set of loan level pricing adjustments. So we're going to talk today about the most common ones, which are set by Fannie Mae. Fannie Mae is a GSE. It's a government-sponsored entity. It's one of the two types of conventional loans. They set their own guidelines and they have their own loan level pricing adjustments. So let's take a look at them. Fannie Mae says for purchase money, this is actually a rate sheet. This is actually their adjustments before any lender margins or anything. But purchase money, that means if you're buying a house, if you have, depending on your credit score, is going to depend on where you fall here for this row, and depending on how much you're putting down is going to depend on where you fall here for your base adjustment. There's more to it, there's more down here, but we're just talking right now about the base adjustment. So if you look at this chart, if you have a 680 credit score, 690 credit score, 698, 681, anywhere within from 680 to 699, and you say you want to put 5% down on the home, well, the base adjustment will land you right here, 1.375%. Now, a lot of people ask, hey, is that 1.375% higher on my interest rate? No, it's your loan amount multiplied by 1.375%, and that's how much will be added in cost. Your interest rate has to absorb some of that cost. So you have what's called a rate sheet, let's say from 4 to 7% or whatever the rate sheet is today or when you're watching this. And depending on where the costs are will depend on where your rate would be, where you want to have any points. Or you can just pay this out of pocket. So if you look at the next one, if you look at, okay, well, if I can get my credit score to 740, what would that same adjustment be? If you get your credit score to 740, you're putting that same 5% down that you were paying 1.375% of your loan amount and cost on, that 740 with the same 5% down will cost you 0.625, so literally half of the cost for the base adjustment. How much is that? 1.375. Let's say your loan amount is $100,000 for easy math. That's $1,375 in cost that you have for the base adjustment. That goes down to $625 if you get your credit score up to a 740. So if you look at it from an investor standpoint, it kind of makes sense. The higher the credit score, that means the borrower has a good history of paying their debts. The less the risk, you're going to get rewarded on it for having a better credit score. Same thing with if you put some skin in the game. You have 5% down, there's different adjustments for 3% down. And here's the really kind of quirky part about this. If you look here, if you have a 640 credit score and you're putting 5% down, you're going to be charged 1.875% of your loan amount. If it's a $100,000 loan amount, $1,875. If you're a first-time home buyer, you can put 3% down. If you're putting 3% down on a Fannie Mae product, that goes down. It's actually less, even though it's more risk because you're putting less down payment. The pricing adjustment goes down to 1.5, and they do this intentionally. So what about if you get your credit score up to a 740? Let's look at the chart. If you got your credit score from a 680 to 740, this would be your row. And depending on how much you put down will depend on what your adjustment is. So let's say that same scenario where you're putting 5% down, you're going to be charged 0.625. 0.625% of your loan amount will be the base charge, the base adjustments. Remember, there's more that are going to go into this. 0.625, let's say it's a $100,000 loan amount, and you had your credit score at 680, it was 1.375, that's $1,375 if your loan amount is at 100,000. If you get your credit score up to 740, that goes down to $625. It's literally cut in half. So you can see the benefits of understanding this chart, understanding where you need to fall on this chart and what adjustments you can make. But if you look, you really need to understand this, or at least your loan officer really needs to understand this to make sure they're putting you in the correct program and guiding you the right way. 640 credit score, we said 1.875 for 5% down. Take a look at this. If you're putting 3% down, that actually goes down. You're putting less money down and you're paying less cost because you're putting less money down. And they do that for a reason. This is to target first-time home buyers. Those are the only people who can put 3% down. And if you're a first-time home buyer, then you can put 3% down and you have a little bit less in cost. That 0.625 goes to 0.5. The 1.875 goes to 1.5. If you have less than 639 credit, the 2.25 goes to 1.75, half a point on there. And as you go higher, up and up on the loan amount, this makes a really big impact. So let's take a look at the next set of adjustments. So that was for the base adjustment based on credit score and loan to value, which means how much you're putting down. So let's take a look at the next set of adjustments. The next set of adjustments will also look at your loan to value range, how much money you're putting down, the percentage down, but also is going to look at some features of the loan. First loan feature we'll look at is adjustable rate mortgage. So adjustable rate mortgage, it really doesn't matter until you get into the lower down payment parts, 10% down or less. That's when you have an adjustment there. Condominiums are looked at by investors as being more risky, so you'll have adjustments there even if you're putting less than 40% down, the adjustments will start. So you'll have the base one and you'll have this one. If it's an investment property, of course, people are more likely to walk away from an investment property or a second home rather than their primary residence. So they have adjustments there, manufactured home because of marketability, adjustments there. If it's a multifamily home, looked at as more risky, adjustments there, high balance, they have to lend out more money. And a subordination agreement means if you're going to have a second lien on the home and you need that, or there's another lien on the home and you need that other lien subordinated, which means just staying in place, they're going to charge you for that. So it's important to understand where all of these are. And if you go on, depending on your scenario, you can have, if you're doing cash out, if you're you'll have different adjustments there. That first one that we're looking at was for purchase. Cash out has different adjustments depending on the loan type. It's going to depend on your adjustments. Here's cash out refi. We're still looking at that. So these are just the base adjustments set by Fannie Mae. Across the board, across the country, whatever lender you go through, if they're going through Fannie Mae, if it's a Fannie Mae conventional loan, you're going to have these adjustments. You can also have adjustments that are set by the lender. A lender can say, hey, for our files, this credit score seems to be riskier for us, so we're going to have an adjustment there for people with this credit score or that credit score. Or it can be vice versa. We're going to give credits to people who have this credit score or that credit score. So knowing the adjustments and understanding this is really important to make sure you get the best possible pricing scenario for you and your family. First and foremost, what I believe, I'm a little biased in this, but what I believe is who you're talking to matters. One, with their experience, where they actually understand this stuff, and two, who they represent. If you're talking to a loan officer who works for a direct lender, understand that direct lenders, if you think they're a big shop is better, it's not. Those big shops have the loan officers, have their team leaders, have their managers, have their vice presidents, have layers and layers and layers of salaries they have to pay, and they have to bake that into their rate sheets. So you'll see their base pricing at a direct lender will be much higher than somebody, say like myself, where we're on the wholesale side. Whether you're a correspondent or a broker, if you're on the wholesale side, you're working with somebody on the wholesale side, you'll have much more aggressive pricing than a direct lender. So it's important to start there. Start with findabroker.com, call us here at Sonic Loans. Either way, get on the wholesale side first, and then even on the wholesale side, you gotta make sure your loan officer understands this stuff and is putting you in the correct program for you and your family. It can cost you thousands of dollars to be in the incorrect program. So this is a lot. Loan level pricing adjustments are a lot even for loan officers. Believe it or not, I've led hundreds, if not thousands, of loan officers in my career, and a lot of loan officers do not understand this stuff. There's pricing calculators, pricing engines that'll help them. They'll put in a scenario and it'll price it out and they'll just know where to go. But you need a loan officer who knows how to make adjustments where those adjustments need to be, because it could end up saving you thousands. So I'm gonna give you a few tips. One, who you're talking to and who you're working with matters. When it comes to the loan officer's experience and understanding and having product knowledge and understanding what they do, they gotta be full-time, dedicated, have been doing this for a while and understand this stuff. Two, where they work matters. If your loan officer works for a direct lender is gonna have a mortgage banker, and they're gonna have layers and layers of management and supervisors and vice presidents, you name it, they made a title for it. And that title comes with a salary. Those salaries are coming from the rate sheet. So you wanna work with somebody, a loan officer who is on the wholesale side of the market. Wholesale side, they'll work for either a mortgage broker or a correspondent lender. I'm biased in saying that because we're a correspondent lender and a broker here. The reason we are that is by design, because we can get better pricing, more solutions, we have more programs, more options. We could say yes to a lot more people than most people have to say no to, and our pricing is really hard to beat. And especially when you're working with a loan officer who understands this stuff and understands how to structure your program. So whatever you do, talk to a loan officer on the broker side, on the wholesale side, and make sure who you're talking to, understand this stuff and can structure your program to where it benefits you the most, because it can end up saving you thousands for you and your family. Thank you for watching. I hope you found value in this. If you did, please like, subscribe, and share. And see you in the next video. Thank you.